The trade conflict between the United States and China has escalated dramatically in recent months, with tariffs reaching unprecedented levels and threatening to fundamentally reshape global economic relations. The latest round of tariff increases in April 2025 has brought the trade war to new heights, with far-reaching consequences for both countries and the global economy. The conflict, which began during Trump's first term and has intensified during his second presidency, represents one of the most significant economic confrontations in modern history. Donald Trump's advocacy for protectionist trade policies dates back to the 1980s when he was prompted by Japanese economic success. Even then, he argued that the U.S. trade deficit was a burden and that tariffs would promote domestic manufacturing while preventing the United States from being ripped off by trading partners. As early as 2011, Trump stated that China's currency manipulation made it almost impossible for our companies to compete with Chinese companies. Protectionism formed a major plank of Trump's successful 2016 presidential campaign. Upon taking office, he began implementing his economic vision by directing the Office of the United States Trade Representative, USTR, in August 2017 to investigate Chinese economic practices. The resulting report, issued in March 2018, criticized numerous aspects of Chinese economic policy, with particular focus on alleged technology transfer practices that supposedly cost the U.S. economy between $225 billion and $600 billion annually. The investigation provided the justification for the first major salvo in the trade war. In March 2022, Trump requested the USTR to investigate applying tariffs on $50 to $60 billion worth of Chinese goods, citing Section 301 of the Trade Act of 1974. The administration characterized these proposed tariffs as a response to the unfair trade practices of China over the years, including intellectual property theft. This initial action set off a series of escalating measures and countermeasures that would transform the economic relationship between the world's two largest economies. The pattern of escalation established early in the trade war has continued to define the conflict. Each American tariff announcement was met with proportional Chinese retaliation, followed by further American escalation. For example, when the U.S. proposed tariffs on over 1,300 categories of Chinese imports in March 2022, China responded in April by imposing tariffs on 128 products imported from America. After the U.S. declared a 25% tariff on $50 billion of Chinese exports in June, China's Commerce Ministry announced similar retaliatory tariffs for U.S. imports. By late 2019, the United States had imposed approximately $350 billion in tariffs on Chinese imports, while China had imposed approximately $100 billion on U.S. exports. The trade war has reached unprecedented levels in April 2025. On April 2nd, the Trump administration increased the total import tariff on Chinese goods to 54%, prompting immediate vows of retaliation from the Chinese government. What followed was a rapid escalation that has shocked global markets. Over the course of just 1 week, Trump's tariffs on Chinese imports jumped from 54% to 104% and then to a staggering 125%. These figures add to existing levies imposed during Trump's first term and maintained during the Biden administration. China has retaliated decisively, raising additional duties on all U.S. imports to 84%. In a move that isolates China from broader trade policies, Trump announced a 3-month pause on reciprocal tariffs that had just gone into effect for all other countries, pointedly excluding China from this relief. This targeted approach signals that the administration has narrowed its trade confrontation to focus primarily on China. Trump has articulated several justifications for his aggressive tariff policy. He argues that tariffs will encourage U.S. consumers to buy more American-made goods, increase tax revenue, and lead to substantial investment in the country. A central goal is reducing the trade deficit, the gap between the value of goods the U.S. buys from other countries and those it sells to them. The president has repeatedly characterized America as having been taken advantage of by cheaters and pillaged by foreigners. In describing his vision, Trump has stated that jobs and factories will come roaring back into our country. We will supercharge our domestic industrial base. However, there appears to be strategic ambiguity in Trump's approach. While he publicly emphasizes rebuilding American manufacturing, his administration has also suggested the tariffs are negotiating leverage to secure better trade terms. This dual purpose creates uncertainty about the ultimate goal. Is it to encourage a renaissance in American manufacturing or to achieve more favorable trade agreements? Trump has linked his decision not to grant China the same tariff reprieve as other nations to Beijing's swift retaliation, telling reporters, "China wants to make a deal, they just don't know how quite to go about it." This statement suggests the administration sees tariffs as leverage to force concessions in future negotiations. The Chinese government under Xi Jinping has responded firmly to American tariffs. Following each U.S. tariff increase, China has announced its own retaliatory measures, most recently raising duties on U.S. products to 125%. This tit-for-tat pattern has been consistent throughout the trade war. From Beijing's perspective, capitulation to American demands is not an option. Chinese leader Xi Jinping, described as China's most powerful leader in decades, sees no alternative but to stand firm against what China characterizes as America's unilateral bullying. The Chinese government has leveraged the conflict to stoke nationalist sentiment domestically, portraying its retaliation as a necessary defense of national dignity and interests. The view from Beijing differs dramatically from Washington's perspective. While the Trump administration frames the conflict in terms of unfair Chinese practices and their impact on American workers, China perceives the tariffs as an attempt to contain its economic rise and undermine its development model. This fundamental disagreement about the nature of the conflict makes resolution particularly challenging. The trade relationship between the United States and China has already been significantly altered by the tariffs imposed during Trump's first term and maintained by the Biden administration. Total trade in goods between the two economic powers amounted to approximately $585 billion in 2024, with the U.S. importing $440 billion from China while exporting only $145 billion to China. This imbalance resulted in a U.S. trade deficit with China of $295 billion in 2024, equivalent to around 1% of the U.S. economy. While substantial, this represents a decline from previous levels. The share of Chinese goods in total U.S. imports fell from 21% in 2016 to 13% in 2024, indicating that earlier tariffs had already begun reshaping trade patterns. A United Nations analysis from November 2019 concluded that the U.S. tariffs on China are economically hurting both countries. In the United States, the trade war has led to higher costs for manufacturers, higher prices for consumers, and financial difficulties for farmers. The agricultural sector has been particularly hard hit, with Chinese orders for American farm products plummeting. By August 2019, farm exports to China had fallen by $1.3 billion during the first half of the year, putting at risk what had been a $9.1 billion market in 2018, itself down from $19.5 billion in 2017. For China, the trade war contributed to a slowdown in economic and industrial output growth, which was already declining due to internal factors. Chinese industrial output growth fell to a 17-year low in August 2019 amid the escalating conflict. One of the most significant consequences of the trade war has been the reconfiguration of global supply chains. Many American companies have shifted production away from China to other Asian countries. However, this doesn't necessarily mean manufacturing is returning to the United States. Evidence suggests that some Chinese exports are being rerouted through Southeast Asian countries to avoid U.S. tariffs. For example, after the Trump administration imposed 30% tariffs on Chinese imported solar panels in 2018, Chinese manufacturers reportedly shifted assembly operations to countries like Malaysia, Thailand, Cambodia, and Vietnam before exporting the finished products to the U.S., effectively circumventing the tariffs. The current level of tariffs has raised concerns about a potential hard decoupling of the world's two largest economies. Economic decoupling refers to a process where the U.S. and Chinese economies would have virtually no trade or mutual investment, reversing decades of increasing economic integration. Analysts emphasize the severe consequences such a development would have. As Nick Morrow, principal economist for Asia at the Economist Intelligence Unit, noted, "It's really hard to overstate the expected shocks this is going to have, not just to the Chinese economy itself, but also to the entire global trading landscape, as well as on the U.S. The trade war has caused economic damage beyond the two principal combatants. Market instability has been a notable consequence, with stock markets experiencing significant volatility in response to tariff announcements and retaliations. Supply chain disruptions have affected companies globally, requiring costly adjustments to procurement and manufacturing strategies. However, some countries have benefited from manufacturing shifts as production moved out of China. Nations in Southeast Asia have seen increased investment as companies seek to diversify their manufacturing bases away from China while maintaining access to Asian supply networks and labor pools. Trump's tariff policies have faced significant opposition within the United States. Influential voices within his Republican Party have joined opposition Democrats and foreign leaders in criticizing the measures. Business groups have expressed concerns about increased costs and retaliatory tariffs affecting export markets. The agricultural sector has been particularly vocal about the negative impacts of the trade war. When China ordered state-owned enterprises to stop buying U.S. agricultural products in August 2019, Zippy Duvall, president of the American Farm Bureau Federation, called the move a body blow to thousands of farmers and ranchers who are already struggling to get by. The China-USA trade war under Donald Trump represents one of the most significant economic conflicts in recent history. From its beginnings in 2018 to its dramatic escalation in April 2025, the trade war has fundamentally altered the economic relationship between the world's two largest economies and reshaped global trade patterns. What began as targeted tariffs on specific sectors has evolved into broad-based import taxes affecting hundreds of billions of dollars in bilateral trade. With U.S. tariffs on Chinese goods now at 125% and Chinese retaliatory tariffs at similar levels, the conflict shows no signs of resolution. Instead, it appears to be pushing the two economies toward a degree of decoupling that would have been unthinkable a decade ago. The ultimate outcomes of this confrontation remain uncertain. Will it lead to a fundamental restructuring of global supply chains? Will it achieve Trump's stated goals of revitalizing American manufacturing and reducing the trade deficit? Or will the economic pain eventually force both sides to the negotiating table? What is clear is that the economic and geopolitical consequences will reverberate for years to come, affecting not just the United States and China but the entire global economic system.